If I owned a business that had years of flux, making some money, losing some money, maybe it's been on a down curve for the last couple of years. If I go to a bank and I ask them for money, they're not going to want to loan me a whole lot because they're looking at my track record over time and I can have excuses. And the bank is still not going to listen to me. They just see the record over time, and raising money is very hard. However, if I'm that same business owner and I know how to structure an acquisition, and I could find a company that meets the criteria of positive cash flow, positive growth. So I find a business that's got that problem solved and they have a good track record. I can raise all the money to buy them that I need. Now I add them to my business and all of a sudden my business starts to look a whole lot better than it did before because on a consolidated basis, I look terrific. And it just helps me then raise money for the combined business that I couldn't raise for my own business once I own the other company. So there's all kinds of structures and strategies where you can use acquisition to solve your problems. You can use acquisition to solve problems where you don't have the right talent in your business, but you buy a company that has that talent. You can buy a company that's got a product that if you had that product in your product mix, you'd be a much more successful company because of what you could offer to distributors or offer in one package to a consumer. So you use acquisition as a way of identifying the shortfall of your company. And then you fill those holes by companies that you acquire. And then you use financial leverage. In other words, the assets and the cash flow of the company you're buying to generate all the cash you need to buy that company. So acquisition is an art form. It's an art form that you can use to solve any business problem that you have, from lack of financeability to product enhancement, to talent, to anything it is that you need in order to build your company bigger and better. Whatever you're missing, you cannot afford to go out and with your cash go to try to solve every one of those problems. You will not have enough cash, depending on your growth objectives. The way to do it is through acquisition, where you can leverage other people's capital in a structure where the acquired business pays for everything it took to buy them. And that's what we will give you here in our business partnership agreement that will help you to build your company. But only a handful of key numbers that are really essential in getting a business finance. And the biggest one is the debt service coverage ratio. And what that tells the lender, for example, is that there's enough cash flow in the business, not only to repay the loan, but that there's enough margin there by at least 50%. So a coverage ratio of 1.5 is probably the most important number in the business. Deals can get done at a 1.25 too. It's still enough cushion there so that the banker can say, well, okay, even in adverse conditions, the company can lose a little bit of its profitability and still meet the payments to me. But you've got a deal highly probable once you get to 1.5. The other side of it is what percentage of equity capital does the lender want to see in the deal? Some lenders, even if the debt service coverage ratio is satisfactory, still want to know that you've got at least 10% of the purchase price in the deal. That's your skin in the game. That's your equity that you're coming into the deal with. Now, we're pretty good at what we do, and we're able to finesse those requirements in many cases. But that takes 50 years of knowledge and expertise to do that. There have been changes in the way financing is done, but it's not as much as you might think. There are some new types of lending. For example, mezzanine lending was not as big 50 years ago as it is today. Today, it's a major part of acquisitions because it's been tailored to do acquisitions. Asset-based lending is the same. No changes whatsoever. Secured lending, same. No changes whatsoever. Banks still obey. They don't make lending decisions as easily as they did back then. 50 years ago, a lot of deals were more relationship-oriented than they were numbers-oriented. If the banker liked you, respected your integrity, and you had reasonable track record, and you showed integrity, they would back you. Not so today. Today, you got to check all the boxes. It's more bureaucratic. It's more process-oriented than it was then. So it's a little tougher today than it was then, but new types of institutions, new outlooks on lending, like in mezzanine lending, have made it easier. So it cuts both ways. Getting the financing of a deal has always been the key to getting the deal done. Our Partners in Business Acquisition program helps people who are already in business overcome any growth friction that exists in their business. It can be that you don't have good income. It could be that you don't have capital or cash. It can be that you're missing key management people. It can be that you're missing market penetration. It can be that you're missing any aspect of the growth needs of your business. And we can fill them with an acquisition of a company that has exactly what you're missing. And that when we can then consolidate the company and two operations are integrated, you have a complete company with all of the ability that you have to grow. And it doesn't end with one acquisition, because acquisitions are serial when you do it right. You do one after another, filling every necessity that you have for the growth of your business. You look at the giant corporations, they are amalgamated of other companies that they have bought along the way that had great products, great services, great management, unused capital, footprints in geographical locations that were necessary for the acquiring company to have that geographical footprint. So anything you want to do, anything you're going to want to do, there's somebody out there that already knows how to do it and can help you with it. And one of the things we have done here at National Diversified Funding Corporation over the last 50 plus years is pull together all of those resources, external and internal, that it takes to take a business, identify its potential, and package it for funding. And that's where we excel in getting people the money that they need to operate and grow their company.